Imagine standing at a crossroads with your hard-earned money in your hands, wondering where to invest first. Should you dive into the fast-paced world of stocks, where prices rise and fall with the heartbeat of the market, offering the potential for massive growth but also carrying the risk of sudden losses? Or should you put your money into real estate, a tangible asset you can see and touch, providing steady income through rent and long-term appreciation, but requiring more capital, effort, and patience to manage? For many beginners, this decision feels overwhelming, because both paths promise wealth but in very different ways. Stocks have the allure of liquidity and compounding growth, allowing even small amounts of money to multiply over time. Yet they demand emotional discipline and the courage to ride out volatility. Real estate, on the other hand, offers stability and the ability to leverage loans to maximize returns, but it can tie up your money for years, involve maintenance headaches, and expose you to market cycles beyond your control. The truth is, there is no one-size-fits-all answer. Your ideal first investment depends on your financial goals, risk tolerance, available capital, and the lifestyle you want to lead. In this video, we'll break down both options in detail, exploring the advantages, risks, and hidden considerations of stocks and real estate, and guide you toward a strategy that suits you best. By the end, you'll have a clear understanding of how each investment works, why one might be better for you to start with, and how to make your money work smarter, not harder. Whether your goal is rapid growth, passive income, or long-term wealth preservation, understanding these differences is the first step toward making informed decisions that can set the foundation for your financial future. This isn't just theory, it's about practical knowledge that can help you navigate the choices, avoid common mistakes, and begin building wealth on your own terms. Stocks are essentially shares of ownership in a company, a claim on its profits and growth. When you buy a stock, you are not just investing money, you are investing in the potential of that company to grow, innovate, and generate wealth over time. Historically, stocks have offered some of the highest returns among all asset classes. Over decades, the stock market has averaged annual returns of about 7 to 10% after inflation, compounding wealth for those who stay invested long-term. One of the biggest advantages of stocks is liquidity. Unlike physical assets, you can buy and sell shares almost instantly through a brokerage account, giving you flexibility and access to your money when needed. Stocks also offer opportunities for passive income through dividends, which are portions of a company's profits distributed to shareholders. Reinvesting dividends can significantly accelerate wealth creation over time. However, stocks are not without risk. Market volatility is a constant reality. Prices can swing dramatically in response to economic events, corporate earnings, or even global crises. Emotional decision-making can lead to panic selling during downturns, locking in losses rather than benefiting from long-term growth. Another consideration is knowledge and strategy. Understanding financial statements, market trends, and diversification is crucial to reducing risk. Beginners often make the mistake of chasing hot stocks or following trends without a clear plan. Moreover, while stock investing requires less hands-on management than real estate, it demands regular monitoring and research to make informed decisions. Investing consistently, diversifying across sectors, and maintaining a long-term perspective are key to minimizing risk and maximizing returns. For younger investors with a long-time horizon, stocks can be particularly powerful due to the magic of compounding. Even small, regular investments can grow substantially over decades. On the other hand, short-term investors or those with low risk tolerance may find the volatility unsettling. Ultimately, stocks offer a balance of growth potential and liquidity, making them an attractive first investment for those willing to learn, remain disciplined, and focus on long-term wealth building. Real estate investment involves purchasing physical property, such as rental homes, commercial buildings, or land, with the goal of generating income or appreciation. Unlike stocks, real estate is a tangible asset. You can see it, touch it, and directly influence its value. One of the major advantages of real estate is cash flow. Rental income can provide steady monthly returns that help cover mortgages, expenses, and even generate profit. Real estate also benefits from leverage, allowing investors to use mortgages to buy properties worth much more than their initial capital. This means that a relatively small down payment can control a large asset, magnifying returns as the property appreciates over time. Appreciation is another key benefit. Over decades, property values typically rise due to demand, scarcity, and economic growth. This long-term growth can create significant wealth, especially when combined with rental income. Tax advantages also make real estate attractive. Deductions for mortgage interest, depreciation, and maintenance costs can reduce taxable income and increase overall returns. However, real estate has its challenges. It requires substantial upfront capital, making it less accessible to some beginners. Properties demand ongoing management, maintenance, tenant issues, repairs, and vacancies can consume time and money. Illiquidity is another concern. Selling a property can take weeks or months, unlike the instant liquidity of stocks. Market fluctuations also affect property values. Economic downturns, interest rate hikes, or local market changes can temporarily reduce property prices or rental demand. Geographic risk is also unique to real estate. Location heavily influences value and returns. Investors must conduct thorough research on neighborhoods, demographics, and economic trends before purchasing. Real estate can be less volatile than stocks in the short term but is not risk-free. However, for those seeking predictable cash flow, long-term appreciation, and a tangible asset, real estate is a compelling investment option. It's particularly suitable for income-focused investors or those who want to leverage property to build wealth over time. Unlike stocks, it requires more active involvement, planning, and patience, but the combination of income, appreciation, and leverage can make it extremely rewarding for disciplined investors. When deciding where to invest first, understanding returns and risks is critical. Historically, stocks have outperformed real estate in long-term annual returns, averaging 7 to 10% after inflation, compared to real estate's 3 to 6% typical appreciation plus rental income. However, these numbers don't tell the whole story. Stocks are liquid and easy to buy or sell, but they are volatile. A sudden market downturn can temporarily wipe out a significant portion of your portfolio. Real estate, in contrast, is more stable in terms of monthly cash flow, but illiquidity makes it harder to exit quickly if needed. Diversification is a key factor in managing risk. Stocks allow for diversification across sectors, industries, and countries with relatively small capital, reducing exposure to individual company failures. Real estate diversification is harder and often requires more capital, though investing in REITs can mimic this benefit. Risk tolerance plays a major role in the choice. Young investors with decades to ride out market cycles may prefer stocks for their growth potential. Those seeking steady income or tangible assets may gravitate toward real estate. Both investment types are affected by external factors: economic cycles, interest rates, inflation, and government policies. For example, rising interest rates can depress property values while also affecting stock valuations. Inflation affects both asset types differently. Stocks can sometimes hedge through earnings growth, while real estate provides a physical asset that may appreciate with rising prices. Taxes also influence net returns. Stocks incur capital gains taxes and may offer dividends, while real estate offers deductions and depreciation that can reduce taxable income. Understanding these nuances is critical for deciding where to start. Many investors find that a combination of both assets, tailored to their risk profile and goals, maximizes returns while minimizing risk. Ultimately, the decision between stocks and real estate depends not just on historical returns, but on liquidity needs, risk tolerance, capital availability, and long-term objectives. One of the biggest considerations for first-time investors is how much capital you need to get started. Stocks have a low barrier to entry. You can start with just a few dollars using fractional shares or low-cost brokerage accounts. Real estate, on the other hand, typically requires significant upfront capital for a down payment, closing costs, and maintenance reserves. Leverage changes this dynamic. In real estate, a mortgage allows you to control a much larger asset than your initial capital. This amplifies returns if property values rise, but it also increases risk if values fall or rental income declines. Stocks can also be leveraged using margin accounts, but this carries high risk and is not recommended for beginners. For new investors, starting small is key. Fractional shares and low-cost index funds allow beginners to build a diversified stock portfolio without risking large sums. In real estate, consider options like REITs or crowdfunding platforms to invest with smaller amounts while gaining exposure to property markets. Leverage in both investments can accelerate wealth creation, but it must be used wisely. Beginners often underestimate the impact of interest, fees, or market volatility on leveraged positions. Patience and strategy are crucial. Consistent investing over time, reinvesting returns, and gradually increasing exposure is often more effective than trying to maximize leverage immediately. Understanding leverage, risk, and starting small ensures that your first investment lays a foundation for sustainable growth. Ultimately, the best first investment depends on your financial goals, risk tolerance, timeline, and lifestyle. Stocks are ideal for long-term growth, compounding wealth over decades with minimal hands-on management. Real estate is better for those seeking steady cash flow, tangible assets, and potential leverage advantages. Time horizon is critical. Younger investors can ride out stock market volatility and benefit from compounding, while those seeking immediate income may find rental properties more appealing. Risk tolerance also matters. If volatility causes anxiety, real estate stability may feel safer. If liquidity and flexibility are important, stocks offer advantages. Your lifestyle and availability for management should also influence the choice. Real estate requires time, effort, and sometimes active involvement, whereas stocks can be managed passively. Many investors ultimately combine both, diversifying across assets to balance growth, income, and risk. Understanding your goals, resources, and temperament helps make the first investment decision easier and more effective. Starting with one doesn't exclude the other later. The key is to begin, stay consistent, and build knowledge along the way. By understanding the pros, cons, and strategies of stocks and real estate, you can make informed decisions that set the foundation for long-term wealth, financial freedom, and a more secure future. At the end of the day, there is no universal answer to whether you should invest in stocks or real estate. First, it all depends on your personal goals, financial situation, risk tolerance, and the lifestyle you want to create. Stocks offer growth, liquidity, and the power of compounding over time, while real estate provides tangible assets, steady cash flow, and the ability to leverage capital to amplify returns. Both paths have their risks and rewards, and both can build wealth if approached strategically and patiently. The most important step is to start taking action now, even with small investments. Allows your money to begin working for you rather than sitting idle. Educate yourself, understand the mechanics of each market, and align your choices with your long-term vision. Remember, the first investment is not just about the immediate returns, it's about setting a foundation for your financial future and building the habits, knowledge, and discipline that create lasting wealth. Whether you choose stocks, real estate, or a combination of both, the key is consistency, informed decision-making, and the courage to take control of your financial journey. The sooner you start, the sooner your money starts working for you, and the closer you get to financial freedom and the life you've envisioned. The choice is yours, but the best time to invest is always now.